Good morning, everybody. Welcome to another by Mike Bjork. Today is Thursday, December 6th. Uh, Back to the grind. Yesterday was markets were closed due to the morning of former President George H.W. Bush, and so we're back to it. So a lot of the data, as we mentioned on Tuesday, that were scheduled to be released yesterday, are going to be moved over today. Uh, so needless to say, we got a lot to go over. We'll start with the ADP employment number for the month of November. And in October, we had 225,000 new jobs created. It came in at 179,000. A little disappointing because a lot of whisper numbers were right around the 190 range. So it came in a little under what we expected. Tomorrow, we'll get the BLS, the Bureau of Labor Statistics numbers. That will be the main one we'll see. Now, obviously, we're going to be watching the number that they have there, but another number they're going to really be watching is the wage. They're going to be looking for wage inflation. So they're going to be because there's been a lot of talk where the Fed has they're kind of reaching neutral, and receiving a lot of criticism for raising rates and kind of forcing us into a yield curve, a negative yield curve or inverted yield curve, and which usually will put us into a recession. So they're kind of concerned about the criticism because if we got inflation, we got economy slowing down, and inflation coming up, they're kind of at a fine line they're going to be walking here, and it's going to be very tricky on how they're going to maneuver that. So tomorrow will be an interesting day to see what we get for data coming in. Now, to kind of move on here, we got the weekly jobless claims tomorrow. The previous report came in at 236,000 people applying for unemployment. Forecast for this week's numbers is supposed to be 224,000, and it came in at 231,000. So again, as I mentioned in the previous report, we want to keep an eye on this because we have seen this increase in the last several weeks. For a while there, we're down like the 200,000 range and 210 range. Now we're in like the 220. Now we almost kind of skipped the 220. Now we're in the 230 range this last few weeks. So we'll definitely want to keep an eye on this, see if this continues to be a trend, because it looks like we could pretty much have peaked at the job market, and typically that will be an indicator of a upcoming recession too once we've reached the peak of that. Now, productivity for the third quarter, we had initial one came in at 2.2, forecast supposed to remain at 2.2, and it came in at 2.3. So a little bit hotter number for productivity, which is obviously a good thing. And then we got unit labor costs, went from 1.2 down to forecast supposed to be at 1%, and it came a little lower at 0.9%. So cost of unit labor came down a little bit, which helps keep inflation in check. So that's good inflationary numbers right there. So it came in a little less than what we expected. Oh, I'm sorry, I wrote this wrong. Market services, this is supposed to be PMI, excuse me. I mistyped that. On these two indexes, this is the service industry, kind of data coming out in the service industry. Anything above 50 is kind of expansion or optimism. Anything below, of course, is contraction or pessimism. And as you can see, they are in optimism mode here. So we had a 54.8 in October, but it did dip a little down to 54.7. Now, on the other hand, kind of like the what we saw on Monday when we got the manufacturing market services, I'm sorry, ISM non-manufacturing index came in higher. So we had 60.3 in October. Forecast was supposed to dip down a little bit to 59.1. Instead, went upwards to 60.7. So we had kind of a mixed bag on the manufacturing, and we're getting that again here in the services industry here. But still decent numbers there. Factory orders, we had a contraction, as you can see here. It went up in September 0.2%. However, in October, it was supposed to drop 2%, and it dropped slightly more, kind of within range, 2.1%. So let's kind of jump over the headline. The stock market is down. It started the morning down, and then a big event kind of happened here. This is the big one here. Arrest of the CFO for Huawei, I think it's pronounced. Basically, what they are is she is a CFO for Huawei. They're a Chinese mobile company from China, and she was in Canada. At the request of the U.S., the Canadian authorities arrested her, and of course, we're trying to have a calm between between the U.S. and China on this trade, and it looked like we're kind of progressing in the right area, but this might kind of ruffle some feathers in that area, and this has got investors a lot more concerned that this could put more of a wrinkle into those negotiations. that the U.S. would go ahead and arrest her. Now, the reason why the U.S. is putting in an arrest for her is because they believe that Hawaii is going against sanctions and dealing with China, and dealing with Iran, and that's kind of the concerns or the worries with the markets right now. So the market was down, but now it's even down further because of this. Now we got OPEC came out with sorry to kind of jump around here, but OPEC here basically had their meetings. They have it from yesterday to today, and basically, earlier on they said that Russia and Saudi Arabia basically agreed to oil production cuts, but they did cut some, but they didn't ever announce that they agreed to a production. So it did come down a little. They said they're going to go ahead and reduce their productivity a little bit, but so that's kind of news on the oil. So the oil is kind of responding accordingly. Let's go ahead and jump ahead to the bond market. And so since the stock market's down, we're having a flight of safety here. And so far, we're up about 33, 36 basis points. It just broke way above this. That's kind of news I guess we needed to just to be able to break this, because otherwise this would have been a very strong ceiling of resistance here. This Fibonacci and a 100-day moving average, so it's a double layer. And we jumped right ahead. So far, we're up about 36 basis points. And we could easily touch this 200-day moving average with the way the markets are currently moving right now. And obviously that's going to put us in a better pricing scenario for interest rates here. So last time we were up here, as you can see, it was right back in the September. We haven't been in this range for quite some time, since the September time frame here. And then on the other side, 10-year Treasury, it's been a while since we've been way down. It's been tanking a lot further here. We're down just below this Fibonacci level. We'll have to see if this can hold the 2.85 level or if it's going to drop even further. And right now it's down to about 2.84 right now on the 10-year Treasury. And of course, the other concern is the inverted yield curve that we're kind of at that point. So right now we're at about 13 points between the 2-year and the 10-year Treasury, because the 2-year is also down now, about the same level, and there's about 13 points there. So when the Fed raises rates about a quarter point again, it's going to easily put us into a inverted curve right now, and it usually takes about a good year or two before we'll see a recession from that. And then once the job numbers reach a certain level, like the job unemployment rate is the lowest where it's at, usually it's a good 6 to 8 months. We'll see that kind of change as well. So that pretty much wraps things up. If any changes happen, I will definitely post it on Twitter. I'll be putting other stuff on Twitter as well, but you can follow me at Mike Bjork. You guys have a great rest of your day. Thanks so much for watching. We'll see you guys tomorrow. Bye-bye.